Hello everyone and welcome to a very important video to watch. This is going to be about the biggest mistakes in investing. Now definitely pay attention. A lot of people make a lot of mistakes in investing and they don't necessarily know where to get started or what to do. And I think this will be very important for people to pay attention to. First mistake I notice is not investing at all. Obviously it's a mistake. Here on your right I have pictured just the Dow Jones. Since 1980, regardless of how things go, we get on average about a 7 to 10% gain in the market per year. If you're accounting for recessions, even, it's still the case. So that being said, I believe it's most important to get in the market as soon as you turn 18 and you're able to get your own account. If your parents are able to actually get you a parent account early, that'd be fantastic. I know there's a couple different companies that offer that. It's just an account that you can't touch until you turn 18, but they can invest for you, and you can inherit that account later on. As soon as you can get invested, it's honestly the better. Absolutely. And this includes both personal accounts, your own personal investing accounts, 401ks, which are retirement accounts you cannot access until you're older, and Roth IRAs. So a 401k typically would be offered by a company you work for. Ideally, they'll offer anything matching. So if they do match any percent, always max out the percent they match. The reason being that they're absolutely doubling your money right then and there. So if they're matching 5%, you should invest 5% and make it work, because that 5% is really doubled if you think about it. If they're matching what you put in, it's automatically doubling your money, and that's not accounting for any market gain that you get. I love 401ks. It's something that usually is automatically invested. You don't have to worry about it. There's a company that's going to do it for you, whether it be Merrill Lynch, Fidelity, whatever company your business actually does business with. It all depends on who they run their 401k through. They'll go ahead and give you a pretty much a broad, somewhat of an ETF type mutual fund almost, where they have a target set for whatever year you turn 65. This is your target retirement fund, and that's what they invest all that money into. And that pretty much just culminates, depending on how far away it is or how soon it is, your retirement. It depends what is held in that portfolio of stocks. And bonds as well. So if you're retiring a long time from now, they're not going to be that aggressive of a portfolio. It's going to be very minor. They're going to be more focused on gains from dividends and bonds most likely. Whereas if you start investing in a 401k with a retirement target 10 years from now, they might be a little bit more aggressive in that portfolio. So that's something to consider as well. But as soon as you can start getting invested in a 401k, I'd say go for it. If they match it, match everything you can. Roth IRA is similar. So Roth IRA is a retirement account. It is pre-taxed. So you're not paying tax on this until it gets pulled out. That's, I think, the main advantage of a Roth IRA. So you can go ahead and just invest your maximum yearly allotted amount. So you're only allowed to invest a certain amount in your Roth IRA every year. There's an annual contribution limit, and a lot of that is, due to that pre-tax nature. That's how you can get around it a little bit. So just it's important to have both. I know it's two different retirement accounts. It's important to have both. Usually your Roth IRA is going to be 100% taken care of, somewhat of a robo investing, I might say. You have someone taking control of it for you that does all your buying and selling. So that's why I think Roth IRA is fantastic. You could do it through any company, Fidelity, Schwab, Merrill Lynch. They all offer different Roth IRAs for different amounts. The only difference here, there are transaction fees obviously here. So in my opinion, if you're going to do a Roth IRA, I usually would try to make your investments as few as possible, but as large as possible. So if you're going to reach that maximum contribution rate, do it in either 1, 2, just a handful of investments. That way you reduce the amount of fees you're paying and commission fees. That's my perspective on it. But definitely try to max out that contribution rate if you can. And another thing, starting small is definitely not a problem when you're thinking about investing. There's nothing wrong with starting with $100 in the market and only bringing in like $10 every week that you want to do. There's no issue with that. However much money you can get invested in, there's no problem doing it. Just absolutely do it. It's better to do it than not to. Small amounts are better than no amounts, that's for sure. It also just builds a habit of saving. That's an issue I know with a lot of younger people. Saving is not necessarily a priority and people don't think about it. And then once you need that money later on, you don't have it. So this investing, if you for sure set aside a certain amount every week to invest or every month, this will help you budget more and you can actually develop a habit of saving because you can work based off of not necessarily all the money you earn. I know a lot of people who just always when they get their paycheck, they wonder how they're going to spend it all. It's an awful way of thinking. You need to budget it out to where you limit what you're spending, and the rest is going into savings or investments. That's just how it should be. So that's a big mistake of investing. Other than that, I would say chasing short-term gains. Did I say that weird? Chasing short-term gains. Definitely a very concerning aspect here. Chasing short-term gains, I get it. You want your money and you want it quick. So this can be stuff like swing trades, playing earnings, and investing in options. So these all have the ability to make or break you. If things go well, you can make a lot of money. If things don't go well, you can lose a lot of money. So like swing trading will be looking to pick up a stock if you think there's going to be news regarding it and you want to sell it within a month. Very short-term trade idea. Could go very negative for you if things don't work out though. Playing earnings, obviously you're hoping to buy a stock in before their earnings to see what happens, and if it's going to go up, you might invest in a call option. If you believe it's going to go down, you might invest in a put option, or if you believe it's going to go up, you might just invest in the stock itself and try to get some of those gains based off of people increasing their buying on it and increasing share price. Very dangerous game because it's very hard to play earnings and you never know how the market is actually going to take someone's earnings, even if it's good earnings or bad earnings. And finally, that investing in options, obviously there's a lot of mobility in options. They're very volatile and there's a very big guarantee. I wouldn't say guarantee. There's a very big chance you could lose all of your money, and that's different from a normal investing. You typically don't lose all your money unless you invest in garbage companies. But options, if you don't reach that the strike price that you invest in, you could lose every single penny that you put in there, and it's very, very painful to see that kind of loss. Now, there's big term gains in these short-term ones. It's just very dangerous, and I think it's a big mistake without being very intelligent and actually knowing what you're doing. Stay away from this. So, next one, I went too far forward and I apologize. We're going to talk about investing in losers. I call them losers for a couple reasons. I say companies that make no profit are losers because, well, they lose money. That's why they're losers. And then another aspect of losers is going to be penny stocks. I think they're just losers, as in I would call them a loser because they have no friends and they sit alone at lunch. That's what I believe of penny stocks. So here featured I have JCPenney, which this one only goes 2018. Right now the stock's sitting at below $1 a share. So penny stocks to me are anything under the $5 range, and I don't think you should necessarily avoid all penny stocks. I think there's some companies that are undervalued right now that sit there. I just think that in general, penny stocks are a very dangerous game. I think you need to do a lot of research if you want to get involved in penny stocks. So here is just a classic 5-year chart, and you can just see how just every bit of your money is just eroding. So investing in a company like JCPenney now just seems moronic. because these companies, usually you'll see on a 5-year chart, they've lost 90+% of their value. And if you think investing in a company like that is a good idea, you've made a big mistake. Now, there is a difference for companies that are just in short-term issues. They might be sitting down there. Maybe the IPO real low. It all depends. There's a couple things that would lead someone to invest in a penny stock. But if it's a company like this that has seen 90% loss in value per share, just stay away from it. And as far as companies that don't make any profit, it isn't necessarily saying all companies, because some companies can get out of that profit hole, and a lot of companies do. But we're kind of in a time right now where these companies that don't make profit are very highly valued, and it's a very dangerous game right now, because once savvy investors and mutual funds, they catch on to the fact that these companies are just losers, well, they're going to sell out, and we're going to see a lot of stock depreciation. Or in case of a recession, these stocks are going to get hammered. So that's something to consider, but some companies will turn around profit eventually. So you need to also consider that. If you do enough research, again, enough research can definitely compensate for any of these issues. Another issue, I believe, would be a lack of diversification. Don't worry about the world's blurriest chart right here, but definitely I would say avoid investing in only one sector. My example here is going to be the tech bubble. So here's the NASDAQ in the year 2000. You can see we hit that bubble very hard. Everyone was investing in these tech companies, these .com companies, because they thought it was the next biggest business model, which it was. But everyone started investing in them, so they got so overvalued, and then they crashed so hard. So you see that the NASDAQ reached around 4,750 in terms of value there, and then within 2 years went ahead and shot down to almost 1,000. So not really exciting. You see, you don't want your investment to lose 75% of its value within 2 years, but that happened. And now we're kind of on a road to recovery now, so we're somewhere around the 3,000 range for the NASDAQ. So definitely interesting. That's why you don't avoid in one sector only, because you invest in tech during this time, you are about to get hammered. So that's why you need to diversify, and not having enough stocks is also a thing. So you want multiple sectors, and you definitely want multiple stocks. So don't just invest all of your money in one stock, because if you do, there's a good chance you lose all your money. The more you're invested broad term in terms of different stocks, if you're more broad and have more stocks, you have less chance of getting hit harder if one of them fails. That's why like if you think about the major indices that hold all these stocks, they go up 7 to 10% a year, even though some of the stocks within them get hit hard. But it's because they have so many that it kind of levels it out more. It averages out to a lot better than one or two stocks would. So that's why I would say diversification is key. It's very key. And finally, you need to do research, and you have to be confident as well. So you need to be confident when you make an investment decision. Don't be afraid. If you've done the proper research, feel confident and make that investment, so that way you don't miss out on any chance of gaining money. Finally, also, you need to always do your research, and do not invest in a company because someone told you to online. Obviously, I do the stocks to buy series here, which I think is just fun. It gives you an idea. It's not saying to buy these stocks, though. It's saying that's something you should look at. And if you believe you agree with the investment, in my opinion, and the business model itself, then you invest. You have to do your own research. You can't necessarily rely on someone else's research, because it can get you burned pretty heavily. There's a lot of people out there that are just in the interest trying to push garbage companies maybe that they think are good, that really aren't good companies, that if you listen to them, could be awful. So definitely do your own research. That's how you make it successful. These are the main failures I see in the stock market. So thank you for watching, and please like and subscribe if you would like to see more like this. Thank you.